No. Mm-hmm. What do you want those eggs made? Oh. It's already counting down for 140. Mr. Burns, Mr. Burns. What kind of music would Mr. Burns like? Okay, this timer's over. Mm-hmm. On Love 80s Liverpool. Yeah. Mr. Burns.
From the decade that brought you the 18 and the Rubik Cube. This is Love 80s Liverpool. It's first time on Love 80s. Well, what's the answer? Whose first hit single in 1989 was Hanging Tough? Hanging Tough was the first hit in 1989 for New Kids on the Block.
I'm just looking for who's all in attendance. Matt. Is Jennifer going to be here? Okay. Okay. Well, it looks like a 6:31, April 13, 2021 for the Finance and Facilities Committee meeting. I guess we'll get started. The board members present are Daphne Morning, Matthew Campbell, Burl Pickle-Antonio, and myself, Brian Harrison. So if you want to get started with the agenda, we'll let you go. I guess we're started with Red Tree Investments.
All right, hi.
We have Ryan Nelson and Jennifer Trowbridge on the call. They are principals in Red Tree Investments, and they are going to give an overview of the investment activities related to the COPS and the bonds that we recently sold.
Thank you, Mike. Do you know if we can share the screen? Did you find that out?
You should be able to, yes. Can you hit the share button?
I think so.
There you go.
Looks like we're cooking with gas. Good evening, everyone. I'm Ryan Nelson with Red Tree Investment Group.
And I'm Jennifer Trowbridge. Good evening.
I feel like we're broadcasters here, sitting here together. Comes across that, so hopefully we're broadcasting good news for you. Thank you, Mike, for having us here tonight at the Finance Committee to give an update to the group on the recent debt issue and the investment of the proceeds. And we have a brief presentation to go through here. If anyone has questions as we go along, please just stop and ask as we are on that page so we can address it as we run through this. So I'm going to go ahead and get this started.
All right. Thank you, Ryan. So just a quick refresher on our firm. I know Ryan presented, gosh, been what, 2 years ago now, I guess. So at any rate, Ryan and I are the co-founders and the managing partners of the firm. And we built our firm on the notion that clients truly come first. So our entire team lives and breathes that every day. Our primary focus is investing public funds, the vast majority of that for Ohio schools. We currently manage just over $5 billion in assets and have over 160 Ohio schools as clients. And we also work with the city of Gahanna. Next, let's see here. This is our team. I think, Mike, you could probably attest over the years. I believe you've probably talked to nearly everyone in this picture. So just thought it'd be nice to see some faces on there. And a brief look at our partnership. So we began working with the district back in the summer of 2018 when you issued debt for the elementary school. And then as a reminder, the district did a RFP back, I guess, in February for the recent construction funds. And we were awarded that mandate and started in mid-March with the investment management of that. A reminder, the last bullet point there on the right is that US Bank serves as a third-party custodian. I bring that up simply from a risk profile standpoint as a third party. So you have Red Tree, the district, and then US Bank. So it's a nice triangle. So we can't mess with the money. US Bank serves as the safekeeper for the holdings. So I'll briefly review, again, just a refresher on what your allowable securities are. You're governed by Ohio Revised Code Chapter 135. It is pretty limited. As you can see here, there's about 7 different options, but it is for the safety of district funds. And again, this is all we do, so we're very familiar with these asset classes. Ryan will talk a little bit here shortly about getting into more in depth with your particular holdings. But I'll just draw your attention to the final 2 there on the right side, municipal bonds and commercial paper. Those are 2 of the asset classes that we're really looking to maximize in this market. And unfortunately, there is no easy button. I think that's a Staples, the easy button. You can't just go out and invest funds all in one day. It does take time, particularly with municipal bonds. As you know, you've issued debt twice in the last few years, but that's only twice. So think about all of the entities across the state. It's a similar dynamic. So there is availability, but not nearly as much as some of the other options listed here.
All right, well, thank you, Jennifer. Just real quick, I'm not going to go on and on about the economic update, but just to let you know about the world that we're living in and investing funds. It is quite difficult in today's markets to invest funds. There's a lot going on in the economy and the recovery of our economy, given the pandemic that's been going on over the past year. There's some bright spots. We have seen jobs have rebounded from the lows of this time last year. We were down about 22 million jobs, and now we're down only about 8 million. But there's some positive points there. Globally, obviously, this is not just an issue here in the United States. And one thing that we're keeping a very close eye on is inflation. And will inflation rear its ugly head because of all of the stimulus going on throughout the economy, higher prices in gasoline and chip makers. I heard that cars are having a hard time finding chips. And it could also lead into higher costs for the project for wood, et cetera, et cetera. So something to be mindful of with the project. One thing I do want to point out here is a quick interest rate update, just to give you a flavor of the world that Mike and we're living in as we invest not only these funds, but other funds of the district. This time last year, with everything going on in the markets and with the economy, interest rates were dropped to 0, and that's where they remain, or near 0, I should say. But to give you just an idea about the world we're living in here, about how low interest rates are, on the chart on the right-hand side, if we just focus on the 2-year Treasury bond at the end of March, that is yielding at 0.16%. That's not 1.6%, that's 0.16%. That's even hard to say out loud. And so that is the world that we're living in to invest these funds. So that's 0.16% is what that equates to. And it's a wonderful time, as you all know, to issue debt. You issued $250 million in debt in the lowest interest rate period in the past 50 years. And that's what matters to the community as and that you're in that low interest rate environment for the bonds. But now on the flip side, we're trying to make the most of these funds in this low interest rate environment. So I just wanted to give you a flavor of, and as we talk about investing, that is what we're dealing with right now, are these ultra low rates.
So quickly, just going back to the 2018 project funds to give you an update where we are there. So as a reminder, that was to build the Lincoln Elementary. It funded in the summer, August of 2018, with originally $32 million. It is now winding down. We originally gave a projected interest number of $900,000. And once everything's said and done, the final maturity will be this summer. We should be earning, it should be $1,360,000. So we're quite a bit over that original $900,000 projection. So that's good news. And now we'll move to where we are with the new funds.
I don't think Scott is on here tonight, so I know that Scott loved that type of information, that he had extra money to spend on the project there. But let's talk a little bit about the new issue that was recently done. And Mike, this was a chart that we had shared with you last month, but I want to give the crowd here an idea about where we're at with the project schedule and how that's looking with where potentially we're going to see estimated interest earnings for this project. The project draw schedule was information that Mike provided us here. And it is simply a roadmap. Obviously, this is going to change over the life of the project, but it's something to work off of today. And Mike knows that he does need to meet certain spending requirements, which I'm not going to get into tonight. But this is what we're working off of right now about over the next few years about when these funds would be spent. And we've layered that over kind of where interest rates are in the market today and where we think we can invest these funds. So for this illustration here, we've used 3 different interest rate scenarios of a 0.25, a 0.30, and a 0.35, just to give you an idea of where we're looking at for potential interest earnings over the life of this project. Unfortunately, it is, again, hard to look at this, that this is $250 million, and the previous issue was $32 million, and we're going to maybe earn less interest depending on interest rates. Interest rates were much higher back in 2018, so we were able to take advantage of some higher rates. But this will be continually updated from if the draw schedule changes, if the market is changing, we can get some higher interest rates. But just to give you a roadmap about kind of maybe what to expect given today's markets about where interest would be. And this is just FYI, this is for both for the voted debt issue and for the COPS combined. Speaking of that, I wanted to give you an update on the progress of investing the funds. And through the end of March, the funds settled on March 17th and March 18th. So we had about 11 trading days in the month of March to get funds put to work. Just because you had a bunch of money on one day doesn't mean you go out and race and invest it all in one single day. You make certain that you're very patient and thorough with the types of securities you're purchasing. But for your purposes here tonight, there are 4 separate investment accounts, and those are done for a reason, legal reasons. And the voted debt issue, the 2001 construction funds, those funds are needed for the high school and elementary and the middle school renovations. And we're still working through getting these funds invested. The other account is the COPS funds. And these funds were issued for $48 million. These funds can only be used for the high school. And we work with Mike and we work with Bricker and Eckler about a discussion on these funds, making certain they're kept separate and knowing where can these funds be used. And that's something we're going to be working with Mike on as we go through the project about when he's pulling money out of these accounts, where should he be pulling the money out of? So those are the 2 project fund accounts. The other 2 accounts that we're assisting on are related to debt service from the issue. One of them is called capitalized interest, and this is related to the larger issue. It was right around $12.5 million. This is going to be needed for the first few years of interest payments. So we've taken the debt schedule and we've laddered out investments to meet those specific interest payments in the coming years. And something very similar is for the COPS account. They actually call that a lease payment account, but very similar there. It's structured to meet the debt service payments, the interest payments in particular for the first few years. So those are the 4 different investment accounts that we currently manage for the new project. And it is a continued work in process, as I can only stress that enough. Through the end of March, we had about $90 million left to invest. So we got a lot done in March, but we still had some work to be done. And there's going to be about $10 million left by the end of this month to invest. So we're almost there, Mike. about getting all the funds placed out of the money market fund. You know, our strategy here, as Jennifer mentioned, we were looking at the Ohio municipal bonds, if and when we can find them. And we have been maximizing commercial paper, which is an eligible investment option as well. It's a short-term investment option. These combined gives us a lot of flexibility in the portfolio. Interest rates are extremely low. There's not a lot of room for them to fall. There's a lot more room for them to rise. So we certainly want to have a little bit of powder on the side to take advantage of higher rates if they do show up. Communication is key, and we do talk to Mike quite often, not only with the existing project that we were managing, but with this one as well. What's going on with the project? Is something changing? This is keeping track of spending is really big for this project as well. So working with him, coming up with ideas about how we're going to track that to make certain that you know, the spending requirements are being met. So that is what we're doing in a nutshell. I'm not getting granular in the type, you know, exactly which investments what, but do know that we're following the investment policy and those allowable investments that Jennifer talked about earlier, to make the most that we possibly can with these funds without putting any undue risk into the portfolio. Any questions I can answer from the group tonight, or Jennifer for that matter? Mike, any questions? You.
I have a question.
Yes.
With regard to the capitalized interest
Yes.
account and the lease payments, will those be refilled like on an interim basis
That's an
throughout
excellent.
the life of the loan?
That's an excellent question. So these two accounts here were part of the actual bond issue, and to meet the first few years of interest payments. The remaining interest payments will be paid from annual debt service collections that the district will receive from the county. Does that answer your question?
Yes, it does. Thank you.
Yes. I think Mike has a question, but he's on mute, or he's just singing. There you go.
Sorry. Yeah, so we collect funds in the Permanent Improvement Fund, which are collected based upon the PI levy of 1.5 mils that was passed. It's yielding something yet less than that today because of the increase in home values. But that stream of income will satisfy the lease payments under the COPS issue. And then we also collect on the bond issue through the debt service fund. So those are two separate funds that are used to collect and make the payments.
And the reason we know for the capitalized interest and the lease payments that were part of the debt issue, many times people just simply leave them uninvested. And we're all about trying to eke out every extra dollar that we can. So that's why we look at those debt schedules to see where we can place some investments, because some of these payments won't be needed for a few years. So that's the things we're doing on the backside here, just to try to eke out every dollar that we can. Mike, did you have any other questions? I know you were on mute there earlier.
No other questions.
Does anyone else have anything else? Okay, well, I guess, I want to thank you for your presentation and.
Well, thank you. Thank the school district for working with Red Tree, not only on the 2018 project, but this project as well. We look forward to working with you over the next couple of years. And Mike knows this, but and tell Scott as well, as the changes with this project go along, make certain that they're fed to us so that we can incorporate them into the portfolio. So you have a lot of work to do there, I know, with these projects, and
Right.
amongst other things that you have to do. So
Yeah.
thank you very much for the
Thank you
opportunity.
all.
If we can ever answer questions, just please feed them through Mike and we'll have to help.
I appreciate it.
Have a good evening.
Have a good night. Thank you.
You too as well. Okay, I guess we'll go next into the March financials. Mike.
Okay. So I need to find the share button. Share screen. Okay, I think this is a little large. Let's see if I could share the other document that I have. Okay, can everyone see that? Okay. It does work. Okay, so first, just a summary of results for March year to date. Our collections for tax revenues, I updated this chart because the actual estimates that were on my spreadsheet were lower than what we are collecting, and we need to adjust our estimated revenues. My initial formula did not include the public utility personal property revenues. So that has been now added to the estimate. There was no change in actuals. The actuals are correct, but I did update the estimate so that it would be more in line with what reality is today. So you can see our tax collections based on, and more in line with the forecast. So this now aligns more with forecasted revenues. So real estate taxes are 200,000 over estimates year to date. There are no more estimates for the balance of the year because effectively we have now settled all tax collection payments. The only thing to be received yet would be the rollback in homestead, which usually comes in the May timeframe. Where we are seeing a large increase in revenues is in tax abatement, revenue sharing, and TIF agreements. We do have about a $500,000 increase over last year in tax settlement agreements. So as we encounter properties, commercial and industrial properties that are significantly undervalued based upon sale price, recent sale price or other measures, we would file complaints and then we negotiate settlements. And usually we have a law firm that handles that, and it's been able to bring in some additional revenues. So those continue to increase. We have seen some significant increases in some of the tax abatement agreements related to Easton, and also some of the Creekside and other agreements. So we have probably 20 or so that are in force today. And a number of them have yielded numbers in excess of estimates. One of the reasons I think is that, at least economically, they are still maybe not doing as poorly as we anticipated, because we did hedge a significant amount on those agreements because we felt there could be challenges and or reduced collections. So that's a good news story as far as tax abatement, TIF, and revenue sharing. The other categories are fairly consistent with where they've been trending all year. On the state foundation side, there was a true up in collections, so that going forward, we'll see a slight reduction to that increase for the next several months, where the state provided additional funding this past month. So overall, we're about 4.1 million in excess of estimates year to date. And then there were some other revenues. You're aware of the 400,000 or so from the settlement of the insurance fund that we had in force. But this month, we also processed the premium payments, collection of premium for the sale of the bonds and the COPS. That is offset by an expenditure for the same amount, which appears below. And we were modifying appropriations for that purpose, so that the money was collected and as part of the proceeds, and then it was remitted to the various firms that we use to actually sell the debt. Down below, salaries and wages, slightly under estimates at this point, and I do project we will be slightly under at the end of the year. Fringe benefits continue to underrun and will continue to do so because of the, again, smaller increase in healthcare costs that we had, which we,
Mike,
yes.
Mike, can you scroll down on your screen? Because it didn't move for us.
Oh, this here? Okay, I'm sorry. Does that work? That doesn't scroll? That's kind of odd.
Yeah, okay. I mean, I guess I just thought it would be better if we could see it, but if we can't.
Yeah, if I drag it or scroll down, you're not seeing it, right? Do you see it now in terms of the full page? No?
No.
No, I mean, I don't think we can see that your cursor is on the Excel sheet even. At least I'm not seeing it.
So when I zoom in, you don't see it being larger? No. I'm not sure how else I can open this. I opened it with a link.
Perhaps just go out and come back in to it and that'll unlock it.
Okay. Are you seeing the agenda right now? No.
No. Do you ever think this camera thing hates you?
Yes. It's even when I think I have it working, it's not working. Can you see that?
It hasn't changed from
It
the
hasn't
original
changed.
revenue side.
Huh. I apologize. I mean, let me download it again. Your screen sharing is paused. Why is that?
Well, that's exactly what's happened. It's paused.
How do you unpause?
I don't know. I wish I could help you.
Oh, well, let me stop sharing and try to share again. Sorry. That's not it. That's not it.
Mike, I think you're frozen now.
Yeah, it says Zoom meeting not responding. I may need to exit. Sorry, I think I may need to exit and log back in. Can you hear me?
Yes, I think that's a good strategy. While he's doing that, I mean, if we just want to have a quick discussion, I have to say, if you look at the tax abatement revenue sharing and TIF line, our actual in fiscal 2020
Okay, I'm back in.
was 5.7 million. And in essence, we aren't finished the year yet, and we're at 10.5. So it literally has almost doubled, which is terrific.
I don't know why that document is not in my selection. It's open. Screen sharing.
Okay, well, this looks like a mind memory game. Like you have to remember the pattern. You're killing me, Mike. That's crazy busy.
Okay. No, that's not what I want. Do you see anything on the screen now?
Yeah, we do.
Yes,
The revenue summary report.
yes,
Okay. Do you see that monthly financial report now?
Yes.
Okay.
let's go for it.
Is it scrolling?
Yes.
Yeah, Mike, if you hit the plus sign that you see there,
Yes, to make it larger, but I'm not sure why it stopped scrolling before.
yeah, there you go.
Okay. I'm sorry for that journey through technology. I'm not sure what to call it. So again, salaries and wages slightly better than estimates. Fringe benefits will continue to underrun. Project that to be, in the 800 or so thousand underrun for the year. Purchase services, the spending for purchase services and materials and supplies has started to tick up as we have come back to school full time. The expenditures have started to rise. If you think about fuel cost and other things and utilities and those types of expenditures as students are in the school, certainly we're going to be expending more funds. We are still on the utilities are still running by 250,000. There's a huge underrun in substitute costs because normally when we're in school full time, there would be a number of substitutes that are throughout the year. Since we were on distance learning or remote in most cases, that cost did not materialize. We're underrunning by $500,000. Travel and meeting expense, 100,000. So various items that are all underrunning. On the bus, fuel, parts and tires, 150,000 underrun. So a lot of those things are related to whether or not we are in or out of school. So those expenditures are ticking up. We will underrun for the year. As you remember, we increased appropriations and in anticipation of more spending related to COVID. Some of that also either did not materialize or has been covered by the ESSER funds that we received from the state and federal government. So to the extent we're receiving additional dollars, that will help with the future forecasts. To the extent we can cover shortfalls related to things like food service, athletics, where revenue receipts are down, but we still have expenditures related to many of the programs. Those funds that were provided by the federal government can be used for that purpose. And the fact that food service is actually doing better than we anticipated due to state reimbursements and federal reimbursements is a good thing. On the operational fees, you can see we're 2 million over estimates for the month. That's due to the expenditure related to the COPS and the bonds issue. So that'll be offset when we increase the appropriation for that.
Mike, can I ask a question on that purchase service line?
Yeah.
In past years, it's been in the 2.6 million range. And we had it projected at 9.1. Oh, that's just for the month.
That's year to date.
Okay, year to date.
It's 8 million year to date.
So what am I missing? Yeah, it's comparable to other years though, right?
If we look at last year, it was 8.9.
Okay.
We're running 955,000 under last year. And again, that a lot of that makes sense in the fact that we were not in school for extended part of the year.
Okay, all right. Just wanted to look at the right column, and then it's much more in sync.
Okay. If you look at our fund history, again, our 2021 year to date, we've collected most all of our taxes at this point, except for the rollback and homestead below. That will equalize once we collect that in May. So the percentages are still kind of skewed, but we will see no more tax revenue for the rest of the year, except for abatement and revenue sharing agreements. This is our bank reconciliation for the month. As you can see, our balance increased significantly, specifically for all of the bond and COPS proceeds and capitalized interest that we received this past month. With meter, when we received our tax collections this month, there was a significant amount of dollars settled. Many other districts that use Heartland Bank also made their deposits into their accounts, and Heartland ended up having a slight issue in terms of its collateralization. That was repaired very quickly because, as you know, any deposits that are government related that are in commercial banks need to be collateralized in order to avoid any potential losses. So they, were able to cover that, but I moved a significant amount of dollars out of Heartland over to Meter in order to maybe try to start gaining some investment yield as opposed to having the money sit in the money market fund. So some of the things that were purchased recently were some of the treasury bills here that go out to 24, 25, and 26 in order to lock in some yield. Some of those are callable, others are fixed in nature, but we still have a significant amount of funds to invest on the Meter side. And also keep in mind in terms of cash flow, because our tax collections or receipts for the next 3 months will be somewhat limited. but our expenditures are fairly consistent on a month-to-month basis. Therefore, we will start seeing a decrease in our cash balances over the next, April, May, June timeframe. Here's a summary of where everything is invested currently. The Heartland money market account still has a significant balance. Meter, the cash that needs to be invested. And Red Tree, you can see the 268 million or so, 269 related to the bonds and COPS, plus the 7.5 million yet to be spent for the project for Lincoln Elementary. Since our forecast now shows that we are solvent through 2024, and we actually have a cash balance in 2025, but it goes negative because of the reserve, we can invest out longer term. So where previous to the approval or passage of the levy in November, I was very restricted in terms of investing, to a 1 to 2 year time frame, because without those additional funds, we would have needed that cash. Now, since we were somewhat solvent in the forecast, we can invest longer term and hopefully get some additional yield. These are some of the detailed reports that you typically receive on a monthly basis. There's one additional chart further down here. There we go. So this just gives a summary of our funds and where we are relative to appropriations. So you can see the general fund, and we're still within limits, and all of the other funds are still within limits. We don't have any potential of overrunning appropriations at this point. Depending upon collections to be received, those can be adjusted. And when we review some of the changes that we're making this month in terms of appropriations and revenue increases, that would affect these going forward. Any questions on any of the items I talked about? Okay. Next thing on the agenda, can you see this on your screen now? Okay. So next we were just reviewing some of the changes we're making to appropriations and estimated revenues. The Coronavirus Relief Fund, which was a state fund, we initially had appropriated $452,000. That included money for broadband connectivity, and a piece of that was not allowed. So we were able to, or Matt, I should say, Matt Blackwell was able to apply for that through E-rate, and we were reimbursed 50%. But we need to reduce the appropriation and the estimated revenues relative to that piece of the project, and the rest will be collected. There was an increase in appropriation award relative to Title I programs. So normally any adjustments to the federal programs usually have an equal amount of increase to appropriation as well as revenues. And then here's a summary of activity within the bond retirement fund. So the 7.9 million related to expected expenditures this fiscal year. We're now adding additional expenditures in June relative to the new issues. So that increases the appropriations. The revenue increase was the amount of capitalized interest or premium on the bonds that we sold. So that money is deposited in the debt service fund, and that will be used to make payments for principal and interest over the next couple of years, after which we will use proceeds from the bond levy. In the PI fund, same type of situation, increase in the payments due to the COPS issue, and on the appropriation side, increase in revenues related to capitalized interest. On the building fund, which is the construction funds, we are hitting estimated 30 million for the balance of this fiscal year, in order to accommodate purchase orders for architects and maybe the CMR and some other activity. That is subject to change depending upon how quickly things progress and we actually create those purchase orders and or start any type of activity related to the buildings. On the revenue side, the 253,665,000 is the total that we collected this month for the bond and COPS issue. And then there are some other small changes to other funds. One thing in our forecast, as you know, we're building up a cash reserve. So wanted to talk briefly about that. This year we were scheduled to add 3 million to the cash reserve. Depending upon how we end up the year in terms of cash balance, if we are in excess of what was estimated, we could potentially put more into the reserve, or we can continue along with the schedule that we have. So we could talk about that more once I get into more details of the forecast and see where we're going to be in the next 4 years or so. But it is an option that we could accelerate the increase in the cash balance fund that we would like to have 60 days. Okay. And I was just going to briefly talk about the forecast. So as you know, we need to file an update to our November forecast by the end of May. So that'll be voted on at the May regular board meeting. I would strive to have the forecast completed, sometime prior to the meeting, or at least, I'm hoping a week or so prior to the meeting, so you have time to review it. And I will certainly be in discussion with Daphne and Brian relative to Finance Committee on any significant changes that might happen. When we updated the forecast based upon actual results, there was a very minimal impact. So the actual tax collection in terms of what we had estimated was pretty much spot on in terms of the next 3 to 4 years. We did have some reduction in terms of what we had estimated in property values. So, for example, the county auditor gave us 13.26% as an increase to commercial industrial property class 2. That actually came in at 8.21%. So that shows up as a $21 million reduction in valuation, which lowers the receipts going forward. On the class 1, residential agricultural, we were much closer. And we did make up some when it came to estimates for new construction. So we had estimates of 6 million, it came in at 10.8. And we had estimates in class 2 of 4, and it came in at 4.8. So those are always going to have variances. Those tended to offset some of the reductions based upon what the auditor had told us the increases would be. But overall, the net impact to the forecast just by adjusting for tax revenues was only 300,000 negative over the 4-year period. So in that respect, we're good from the tax side of things. Now, there are certainly other adjustments that need to take place in terms of estimated revenues for local revenues. We are seeing an increase, as I talked about, in the tax settlement agreements and TIFs. So that's going to be a positive impact. And in terms of expenditures, we're underrunning this year. I would expect if we're in school next year, assuming COVID is behind us for next school year, that we would be back in school full time and things would be back to somewhat normal and we would see an increase in that spending. So in terms of forecasting it, that's the assumption that we would make. And depending upon where we end up this year and what those run rates are, I would anticipate some slight benefit to the forecast going forward also. So net, when you look at the next 3 to 4 years of the forecast, I would expect it to improve over what we showed in November.
Mike, I'm just curious, did the auditor give any background or reasoning behind the 13% projected versus 8% reality for commercial?
I did not speak with him, so, but I could follow up and ask as to why that, was lower.
I'm just
I
curious.
think it's consistent across, the in the county and all the districts in terms of what was provided as the estimate and what the actual was.
Oh, okay.
They were lower.
Gotcha. So it's not just a Gehanna thing.
It's not just Gehanna.
Okay.
Yeah.
Then skip my question.
So as far as the forecast also goes, I've asked the directors and Steve and Jill to provide any input in terms of incremental programs, incremental staffing, or those type of things, which we would be over and above the run rate. So anyone who is on staff now who is continuing is basically in our projected expenditures. But we do know that with the opening of new schools and the additions to new schools, we will see an increase in staffing. Some of that was included in the November forecast. We had, I believe, 19 additional certified staff in that forecast. If that happens to become 24 or 25, then that certainly would have a detrimental impact to the expenditures that were forecasted. The forecast also assumes certain amounts of increase for inflation. If inflation ticks up, that could also impact it negatively. So there's always moving parts when it comes to, it's somewhat of an art. It's a science, but it has a bit of an art to it. I'll keep the board updated as information changes relative to forecast. If there are significant things that impact us, certainly on the negative side, I will inform you. I'm not anticipating anything of that nature at this point. I am anticipating that the ESSER funds that we're receiving in ESSER 2, the 4.2 million, will help in terms of offsetting any future increases. And with ESSER 3, if that comes to fruition, that would make a positive impact on us going forward in terms of offsetting expenditures, at least in the next several years, that we would normally incur in the general fund or other funds.
Okay. Does anyone else have any questions or anything or concerns or? Okay, well, I guess that concludes the meeting today. So I'm kind of a little out of it. I had my second Moderna shot and I don't think that my body knows what it wants to do with it right about now. So but it's going forward. But I want to thank everybody for participation and the attendance, and everybody stay safe. And I guess we'll conclude at 7:24. Y'all have a good night.
Thanks. Thanks.